With oil prices low, Exxon Mobil is shifting its strategy. The CEO outlined his plans for the full year ahead at a meeting with analysts, which included possible acquisitions and maintaining its AAA rating and its dividend. Investors liked what they heard. Shares rose nearly 2%. Brennan takes a look at what's in store for one of the most widely owned stocks by individual investors.
Exxon Mobil reaffirmed plans to cut capital spending by 25% this year. Reductions that will come primarily from oil and gas production, with another decrease expected in 2017, in part from chemical operations. On the heels of a massive $12 billion bond sale earlier this week, CEO Rex Tillerson saying the world's largest publicly traded energy company is on the prowl for assets, a process that may take some time to play out.
Valuations, believe it or not, are still not aligned in terms of what companies want versus what we see the value to be. They've taken on additional leverage. They've issued additional shares, diluting their existing shareholders. And in some respects, in doing that, they've destroyed some of the inherent value. So when we look at the assets, we love their assets, but when I look at the balance sheet, I'm buying a house that's got a huge mortgage on it.
Potential deals aside, Exxon expects its production to be 4 to 4.2 million oil equivalent barrels per day annually through 2020. Or basically flat from 2015 levels. But cash flow is expected to grow over that period, and not just as crude prices eventually recover, but due to operational efficiencies as well. Still, some analysts have concerns.
Exxon continues to trade on a large multiple premium versus the other supermajors. And I think it's hard to justify now when you look at the deterioration in returns relative, in cash flow relative, distributions relative. So Exxon talked about previously unmatched shareholder returns. It's now got the lowest dividend yield amongst the integrateds with no buybacks.
Exxon was also put on credit watch by several ratings agencies last month, raising concerns about the future of the energy giant's coveted AAA credit rating. Still, the company maintains it will continue to pay a reliable and growing dividend, stressing that the business is run for people to own XOM shares for a very long time.
The dividend is safe. We have, again, it's part of what we feel is the obligation to our shareholders.
For Nightly Business Report, I'm Brennan in New York City.